Okay, we're exactly at the top of the hour, so let's go ahead and get started. Welcome everyone to our monthly series, our webinar series on building value in your business. I want to talk a little bit about logistics so that you have a sense of what's going to happen during the next roughly 45 minutes. So this webinar is a part of a monthly series that we offer through Innovative Business Advisors, and our goal is to share information about building value in your business. We're using today a system called Zoom Webinar. So you should see on your screen as a part of your interface a bar, perhaps at the bottom, maybe at the top of your screen, and one of the options on your bar is a Q&A option. So you can go ahead and if you would like, type in a couple words in the Q&A session, and that way I know you're there and I know that you hear me. So let's go ahead, each one of you just type in a question for me or a comment, and I can see that you're actually there and that you're hearing me. I see that we have several participants on already. I'm actually inadvertently moving the... Okay, great. So several of you hear me, so several people are actually putting questions in, so good. So let's go ahead and move forward. Okay, so let's talk about what we're doing in these webinar sessions. At Innovative, we offer a consultancy, and what we do in that consultancy is we actually use a specific system and a specific process toward coaching our clients on how they can build value in their businesses. So this series, this webinar series, actually addresses many of the 8 core value drivers in the Value Builder program. There are 8 core drivers, but as we coach and consult with you through the process, it's a 12-month process. So there are actually 12 components or 12 modules in the coaching session. I'm not going to go into detail about that because we did that in the first webinar, but in each webinar I will remind you that that is a key part of what we do at Innovative. And if any of you as audience members are interested in chatting with us about the Value Builder engagement, how it works, give us a call or follow the link. At the end of this webinar, you will receive an email as a participant in the webinar with a link to our webpage so that you can actually get more information about the Value Builder engagement. And you can even go a step forward. You can take the Value Builder assessment, and we will provide information to you, assessment information regarding your company. So let's move forward and talk about today's guest. And today we have as our guest, Terry Lammers. Terry, I'm really delighted to introduce Terry to you because Terry personifies what most business owners are looking for. Terry is the president of Innovative Business Advisors, so he is a part of the company. But it's his life before Innovative that I think is so interesting, and that's what we're going to spend today talking about. Terry just recently, within the last few weeks, published his new book, You Don't Know What You Don't Know, Everything You Need to Know to Buy or Sell a Business. And he, in that book, tells stories about the time that he spent as owner of Tri-County Petroleum. So I'm going to tell you a little bit about Terry. So he's currently a president of and co-owner of Innovative Business Advisors. Innovative was formed in July of 2014 when Terry teamed up with Dave Kunkel of Kunkel Commercial Group. Prior to that, Terry was president and owner of Tri-County Petroleum. He owned that company for over 20 years. He successfully sold that business in 2010. And prior to selling Tri-County, he was involved in 11 successful acquisitions to build Tri-County to the company that it was when he sold it. In addition to the work that Terry did at Tri-County, and he's going to tell you a lot about his story in a minute when we get started on this webinar, Terry also spent 3.5 years with Regions Bank as vice president of commercial banking. And most recently, Terry received his designation as a certified valuation analyst, the CVA accreditation. And he earned that accreditation through we call it NACVA, or the National Association of Certified Valuation Analysts. He also holds a real estate broker's license. And in addition to that, Terry's also a certified value builder. So he certainly is prepared to consult with our clients as we bring you in to address value within your company. So Terry, welcome. And let's get started. So Terry, tell us about your journey in writing your book. Tell us what made you decide to write the book, and what were some of the challenges that you faced in getting the book to the finish line and publishing the book?
So writing a book has always been kind of a bucket list thing for me. And the challenge is I'm a financial guy. I'm no way an English major or anything like that. So I had lunch or breakfast with a guy, and he's like, you know, to write a book, all you got to do is lay out 8 chapters and tell your story, and it's really no big deal. So I planned a quiet weekend, and I started writing a book, and I got into it, and it's like, I have no idea what I'm doing. So through the power of Google, I found a book coach in St. Louis called Nancy Erickson. So much like we coach businesses on building value in their company, I hired a coach myself to help me write the book. And Nancy calls herself the book professor, and she lays kind of a 3-part process out that worked really well and helped you keep you accountable to getting the book done. So the first part is laying the chapters out and talking about what you're going to talk about in each chapter. The second part she calls getting it out, which is actually writing each chapter. And then the third part is polish and perfect. So it's about a year and a half long process. You learn a lot. It's a lot of you don't know what you don't know, but the book's professionally done, and I think it turned out really nice.
Okay, so Terry, in your book, you begin by telling us about the early days of Tri-County Petroleum. Why don't you tell us a little bit about when you finished college and coming home, and what sort of a company was Tri-County when you first started with the business?
Sure. The company originated like in 1920. My dad started working there after he got back from Vietnam. Ended up buying the company in about 1975. So I grew up in the company as a kid, you know, driving around in gas trucks and doing everything that goes along with it. I worked outside of the business for a number of years. It was kind of interesting. I was in banking then. I worked for Mercantile Bank and credit card finance, and the business at one point, we delivered to a lot of small mom and pop gas stations. And if you remember back to the early 1990s, late 80s, 1990s, it's when really all of your 2-bay full service gas stations were given way to the bigger convenience stores that you have today. And those mom and pop gas stations were kind of the core of the business back then. So as they went away, the company was kind of suffering. So, and I knew that there was an opportunity to buy a company. So if we bought this company, it would put us back in the black, and you know, the company would be back on solid ground. So in 1991, I made the decision to leave Mercantile Bank and went back with my mom and dad. And I tell people jokingly that it was me, my mom and dad, and we had 2 trucks, and it was a good day if they both started. So came back to the company with a whopping salary of 0. Started Tri-County. We were actually merged my dad's business into Tri-County, and I bought the first company in April of 1992, which was Bone Oil Company. It did put us back into the black, and it was a little bit of a slow process, but we bought another company. That was in 1992. We bought another company in 1995, then another one in 96, then 3 companies in 2000, and we was kind of off to the races from there. So the first year, and I think year in 1991, we had about $750,000 a year in sales, and when I sold the company in 2010, we was north of $42 million a year in revenue.
Wow, phenomenal growth. So Terry, tell us, why would a business owner decide to grow through acquisition? Obviously, you built substantial value by growing through acquisition. Did you consider simply a marketing strategy to go out and find customers through a marketing initiative versus an acquisition initiative? Talk to your thoughts on that, and why did you choose acquisition as your growth strategy?
Sure. For whatever reason, and I don't know, I think it's with most businesses, really, customers are fairly loyal. If you have good products and good customer service, and your pricing is just as fair as the next guy, it was very difficult for us to go out and acquire accounts. I always tell people I can go out and talk to a potential new client till I'm blue in the face, but if the guy that he's currently doing business with is doing all those things right, it's very difficult to get them to switch their business. If we went and bought that company, we was very successful in keeping like 95% of the customers that we bought through the acquisition. It was a little bit risky because there was no contracts with these customers or anything like that, but what we had kind of developed a good process of, when you bought the company, one, keep it confidential, and then the day that we did close on the company, go around and meet the larger accounts. And if we took the previous owner with us, and the previous owner would tell his customers, look, I chose to sell my company to this guy, give him a chance, because part of the reason I sold to him is because I think they'll do a good job. We was really successful at transitioning those accounts over to us.
So tell me again. Oh, go ahead.
Another advantage of that, especially as we got bigger, we could cross-sell those accounts then. So maybe the previous company only sold them gasoline or diesel fuel, but they didn't buy their lubricants through them because it wasn't competitive. Well, by then we had our own brand of lubricants and sold bulk oil and stuff like that. So, that gave us the opportunity to offer them other products that the previous company couldn't do.
Okay, great. So how did you define the acquisition targets? You purchased 11 companies. Why those 11?
Some of it's maybe just dumb luck or whatever, but that was a period of time where there was people transitioning out of that business. So, not 100% of them, but a majority of the companies that we bought, the owner was ready to retire, and they really, there was this business, the oil business is high. There's a lot of working capital it takes to run that kind of a company, and there wasn't a lot of people out there to actually buy those businesses. So it was a good opportunity for us. So it's kind of a right place, right time type of situation.
So let's talk about, go ahead.
The area that we looked at was either trying to find somebody that currently operated in the market that we already covered or was adjoining to it. So we never did, we was in Southern Illinois. We never, went to Western Missouri or Indiana or Oklahoma to find another company to buy. They was all, just building that area from where we was at. So we started with 3 counties in Illinois. That's where the name Tri-County came up, Madison, Bond, and Clinton County. By the time we sold the company, we covered 14 counties in Southern Illinois and the St. Louis metropolitan area.
Great. Okay. So now this is just a comment for the participants. If you have a question as we go through, go ahead and enter your questions now. We're actually going to go into Q&A right at about 11:30, but go ahead and enter questions if you have them now. We'll queue those up and I will share those questions with Terry as we move forward. So Terry, you've told us about the fact and why you chose the specific companies. How did you determine value? What was your key approach to determining what you would pay or what that company was worth for you?
Sure. It's interesting. For me, it was, and I came up with this on my own, and it kind of works out because it makes the deal bankable, but we always paid, a trigger point for me is if I could pay for the company in 3 to 5 years. So if you're looking at that as a return on your investment, 3 years would be a 33% return on your investment, 5 years would be a 20% return on your investment. That was my trigger point, and usually at a 3 to 5 year payoff, it was a bankable deal that we could get financing on the deal. Ironically, after I sold my company to Growmark, they're a $6 billion company and they have their own acquisition department. I got to ask the lady, Shelley Cruz, I said, hey, what's your trigger point? What makes you pull the trigger on an acquisition? And for Growmark, it was 33%. They look at some things a little bit differently than what I do. I always looked at the existing cash flow of the company, not what the cash flow would look like under me, because I was able to eliminate certain expenses, and I think that's important. I tell that to people today yet. Don't pay for what you're going to bring to the company. You're paying for that company for its existing cash flow. But 3 to 5 years was a trigger point, and even today, doing what Marquita and I do together, that still seems to be a pretty good range.
Okay, great. So after you identified a business to buy and you had a sense of what you would want to offer for that business, what sort of a team did you put together? Who were the key participants in helping you get to the closing table and close that deal? Tell us about the kind of team you needed to get a deal done.
On the buyer side, for me, it was pretty much my attorney and CPA and my banker. So, that was the three key people. Again, most of the acquisitions that we did were bank financed. So it's very, very important to have your banker involved in the process. But, as the years went on, developed I think it was a great practice of sitting down with my bank in January and just saying, hey, here's what my thoughts are for the upcoming year. We're looking at this company, or we're looking at purchasing this truck, or our trucks were $400,000 a piece, so it's not a small acquisition for a truck. But giving them a heads up of what's going on. The attorney was very important. We worked together. I used the same attorney for all of my acquisitions, but he understood M&A, and we knew what the tough conversation points were going to be with the selling company's attorney right out of the gate. So that really helped move things along and help keep expenses down. And your CPA, that's another very important part you need to have involved in the process, as far as how the taxes and allocation of assets of the company you're purchasing and stuff like that's going to work out.
Okay, good. So you built this large, successful company. Why did you decide to sell it? What was the trigger point that made you decide to sell?
I would say there's two main ones. One, in 2006, my dad had a heart attack. I had a great opportunity to work with my dad for several years, and we worked great together. And he survived, thankfully, but he had to leave the company, and it just put a different spin on it for me. It was just different after that. The second thing, probably the biggest one, owning an oil company when fuel goes to $4 a gallon for the first time, and you have 3,000 local customers, local being the key word there, I was just burnt out. It was always a very profitable company, but the capital requirements to run it, and getting just beat up by customers day in and day out. I mean, you couldn't go to a restaurant, you couldn't go to a town picnic or church or anything without 6 or 7 people wanting to pull you aside and talk to you about fuel. So, in hindsight, I don't have no regrets, but I think there's ways that I would coach people around that nowadays. But that was a large part of it. Just the volatility of the pricing, the requirements for working capital, and just done it for a long time, and unfortunately was kind of burnt out.
So how did you make the match with Growmark? Did you hire a broker? How did that come to be?
So I worked with a lady out of Weatherford, Texas. Her name was Betsy Bigsby, and I'd done some speaking for her at some of her conferences and stuff like that. She coached people on cash flow. She also valued businesses. She worked strictly with privately held oil companies, just like mine. And so she valued my business, and she came up with a number, and it's like, if we can get that for it, let's do it. And so they found Growmark, and once Growmark latched onto it, it only took us, once we signed a letter of intent, we was done in 6 weeks. So, that's not by accident. I had planned, that was always my plan, to build the company up and sell it, but that's a unusually short time frame to close on a company.
Certainly is. So now here you sit, you're on the sell side of the transaction as opposed to the buy side. It's your first time on the sell side of the transaction. What were the key things that were different for you as seller versus buyer? Tell us a little bit about the story of how that worked for you.
And this is kind of where the name of the book comes from. You don't know what you don't know, because I used the same players on the sell side as I did on the buy side. And actually, I didn't, because my CPA was a very large customer of mine, so I didn't talk to him about it, and that was a mistake. So I really just used my attorney and my banker. And what I should have done is engaged my CPA much earlier, because of the tax consequences, and I should have sought out the advice of a financial advisor to make sure that the number I thought I was getting, and it all worked out fine. I want to stress that, but I should have sought out the advice of a financial advisor to really work through, is this enough money for retirement, and can I live off of that? Because all of a sudden, you killed that goose, you sold it. So those are some things that I would recommend really working with your team. And it's some of the things that I talk about in the book. I talk about things that I did right, and I talk about things that I should have done different. And those were a couple of things that I should have done different.
What would you say were some of the trickier aspects of getting to the closing table as you prepared to sell the business in that 6-week time frame?
Yeah, so probably the trickiest thing was it didn't sell it to just Growmark. Growmark bought my lubricants division, and then 8 of the FS member companies. So Growmark, under Growmark, Growmark is a co-op, and they have member companies, and they fly under the FS flag, Farm Service. And so Growmark bought the lubricants division, and 8 of their FS member companies bought the fuel side of the business. So actually sold the company to 9 different companies. So that was a trick in determining, what is each one of those companies paying for the company out of the whole piece.
Okay, so tell us about life after business.
That's another thing I didn't do very good. The last chapter in my book, don't be like the dog that caught the car. I had to work for Growmark 6 months after I sold the business, and literally after the end of that 6 months, I had no idea what I was going to do with myself. That is something that you really need to think about. My phone went from ringing 100 times a day to me looking at it and wondering if it was really working. Then, probably funnier yet was my wife. After about 3 months, she's like, you're going to find something to do because you're not hanging around the house all day long. So there's only it was October, so I'm a big hunter, so had more time to go out hunting and doing things like that. But after a while, when you're used to going that fast, you had to find something to do. And that's finally Regions Bank called me one day and wanted me to do commercial banking. It's like, well, you know what? Never worked for I grew up in a town of 600 people, never worked for a company with 20,000 employees. Finance was always kind of my thing. So had a lot of banking experience going from, through the 11 acquisitions. And so that worked out well, and did that for 3.5 years, kind of got my entrepreneurial itch back. And that's when we started Innovative, and we're helping people buy and sell companies now.
Okay, so it looks like I'm fiddling around here with the screen, so I'm going to go forward. And what I'd like to do is spend some time talking about your book, because I'm sure people here are interested in your story and would love to get a copy. So tell us about how we can get a copy of the book.
Yeah, so if you go to Amazon Prime, like you can see on the screen, Google, type my name, search my name, Terry Lammers, and the book should pop up. It's interesting. So the book is about, it starts, I define it as there's kind of like 3 pieces to it. So the beginning of the book talks about buying companies. So why would you buy an existing company versus starting a company from scratch? Or maybe you want to buy a franchise. Then I talk about valuing the company. What are different ways, how do you wrap your hand around, how do I value this thing? How do I come up with a price on it? So there's a chapter on ways to value a company, and it give you some ideas of how to come up with the value of the company. And then there's chapters on what's the process of buying a company. So what's different things that you need to do going through the process of buying a company. The middle of the book, I talk about building your team. So there's chapters on CPAs, attorneys, bankers, financial advisors. I talk a little bit about each one of those and my experiences. Then the book kind of transitions into building value in the company. What makes that company valuable, for you as if you're going to sell it. And that's kind of what's kind of ironic about that is I wrote that chapter before we signed up for the Value Builder System. So a lot of what's in that part of the book is what we do in coaching clients through the Value Builder System. After that chapter, I kind of roll into selling the company. How, what's the process of selling the company and confidentiality, and how do you find a buyer? Do you use a broker? So that's a good discussion. And then the last chapter, like I said, I called it "Don't Be Like the Dog That Caught the Car." I get into life after your business and having a plan of what to do with yourself. So really, you're writing a book, and it's a process. It's a 1.5 year long process, and it's kind of brutal. And you're doing this, and you're like, I don't know, is anybody going to read this thing? But after each chapter, there's discussion points, and this was something that was through my book coach. It's one of the last things I did in writing the book, and I thought it was optional, and I'm kind of burnt out from writing it. Then I'm like, I ain't going to do that. And she's like, no, you have to do this. So when I went through the chapters and started writing the discussion points of what I think you should get out of each chapter, that's when it really kind of hit me that, hey, you know what? If somebody reads this book, they're going to have a really good idea of, buying, selling, building your team. So that's, I think you really get something out of it.
Okay. So Terry, let's start the wrap up now, but let's move forward and open it up to our clients or to our participants. So I know that you guys have access to the Q&A box because many of you have sent me a hello. Glad to see that you're fine, but we're open for questions now. So let's go ahead and take your question. So the way you ask a question is you just simply type your question into your Q&A box and it will pop onto my screen. I will read those questions to Terry and we'll move forward. So do we have any questions?
While we're waiting, Marquita, one of the things that comes up a lot and it can be really difficult in going through the acquisition in a company, and in Value Builder they call it the valuation teeter-totter, but it's the working capital needs of a company. So when I sold Tri-County, we had an accounts receivable of about $3 million in inventory of over $1 million. So that's $400,000 in working capital that Growmark, who bought my company, or whoever would have bought it, has to be able to bring to the table, which is completely separate from the sale price of the company. So not only are you paying X for the company, you have to have this working capital in order to run the company. And that's something that's very important if you're considering buying a company. I always compare that to a gas station. We didn't have C-stores, so when you fill your car up with gas, you pay before you leave. So there is no accounts receivable there. So their working capital requirements, you're actually creating cash, which makes it much easier to buy the company. We sold a drilling company this spring, and their accounts receivable took about 90 days to collect. Is just the nature of the business. So the day that new couple bought that company, it was 90 days before they're going to get in any cash. Well, in that 90 days, you're going to have several payroll cycles and stuff like that. So that's cash above and beyond the purchase price of the company that you have to have in order to run a company. And oftentimes that can make it very difficult to finance a company, or to buy a company and finance that portion of it if you don't have that coming into the deal.
Okay, great. Now it looks like I still don't have any questions coming in. Okay, now I do. Okay, so I do have a question. How do you value the customer list, goodwill, a covenant not to compete versus hard physical assets? So is there value in those things, customer list, goodwill, covenant not to compete?
So when you're valuing a company, that company has purchased assets that generate cash flow. As a CVA, I'm valuing that cash flow from the business. So if the value of that cash flow is greater than the assets that created it, you have goodwill in the company. If the value of that cash flow is less than the assets of the company, when you go to sell that company, you're just having an asset sale. There's essentially no value to the customer list, or there is no goodwill, because the company's worth less than the physical assets. Now, as far as putting a value on the goodwill and the customer list, that's a good discussion with your CPA, and a negotiating factor when buying the company, because the seller is going to want as much value on that goodwill as possible, because that will have a much lower tax consequence for him. The buyer is going to want as much as that purchase price on the physical assets, because then they'll be able to depreciate that asset off, and it's going to save them some money. So in the book, I talk about and in fact, it's in the first page of the book. It was with two accountants that came from the firm you was with, Ron, and it's a very interesting story. We had negotiated the price of the largest company that I was going to buy, and we negotiated a price, but then we was going through the purchase agreement, and we was far apart on what's called the allocation of the assets. So in other words, we wanted, as the buyers, and I had to have more money put towards the physical assets of the company because of the banking requirements for collateral, then the seller wanted a much larger number to goodwill, and we was at an impasse, and it was a hard conversation. We did work our way through it. So in the book I talk about that coming up with the purchase price of the company is one thing, but determining the allocation of that purchase price to the assets of the company is another thing. So that's strictly a negotiation in buying the company.
So Terry, speak to buyer expectation and experience that you've had life after Tri-County Oil, but specifically within Innovative Business Advisors, relative to buyer expectation. As a CVA, what have you seen relative to how spot on, and I'm not saying buyer, I said buyer, seller, the business owner who is about to sell, and their expectation in terms of the business value versus specifics on how you determine value as a certified valuation analyst?
You know, one of the biggest deal killers in selling a business is the business being overpriced, and the seller's expectation. So here's what happens a lot of times: the seller comes to us and they say, you know, I know that my company hasn't done so well as of late, but you know, if somebody comes in here and they spend a little bit more money on marketing, or if they do this or they do that, they could really make a lot of money with this business. Well, you don't value a business on what the seller or the buyer can bring to the table and what he might be able to do with the company. You're valuing that business on its current cash flow. So it's unfortunate that a lot of times you see a seller, you know, I talk about it in the book, but I call it the glider path. You know, they've just over years kind of taken their foot off the accelerator, and that company's just slowly gone down in the income that it's bringing in. And unfortunately, that lowers the value of the company significantly. Probably the next biggest thing that happens with a seller, and it's a complete lack of pre-planning and not working with their team, is they don't realize the tax consequences of selling their business. Most of the time, most of the assets are depreciated off, and we literally had a situation this year because the company was a C Corp. If we sold just the assets of the company, the owners were going to have to bring a check to the table to sell their company. So, you know, it's really important to work with an M&A professional, because there's several different ways to structure the sale of a company and help reduce the tax burden that it creates from selling the company. And keep in mind, I mean, that tax burden can be 40%. That's a huge, you know, that's huge. So if you say you're happy with selling your company for $1 million, and then all of a sudden you realize there's a 40% tax liability tagged along with that, and now you're only receiving $600,000 instead of $1 million, that's a big deal.
Okay, so Terry, we have another question here. Do you frequently see buyers and sellers agreeing to a price without considering allocations of goodwill and assets, or any other terms of the sale? And also, do you see people fail to consider accounts payable and accounts receivable in the terms of the deal? I know you can speak to that.
Yeah, I think that is a problem. And as far as determining the allocation of the assets, that should be talked about sooner in the process, and it is definitely something to think about. So let's talk about accounts payable, accounts receivable. In, I would say, most cases, the seller keeps his cash, the seller collects his accounts receivable and pays off his payables. And typically you're going to see that in an asset purchase. So if I'm selling my company, I'm going to keep the cash that's in the company, I'm going to collect my accounts receivable, and I'm going to pay off all my debt from the company. Now, that being said, you know, we recently purchased another company and we did a stock sale, and I'm negotiating a stock sale of a company right now. So in a stock sale, you're coming in buying the stock of the company, and you know, you're getting that company as it's running right now. Now you can still negotiate what the balance sheet's going to look like. And in other words, you know, they have to leave, say, $50,000 cash in a checkbook, and you know, make sure the accounts payables are current and different things like that. So it's not 100% unusual to do a stock sale, and there's different reasons for doing a stock sale. In our case, there was several contracts that went with the company, and if we did an asset purchase, we'd had to renegotiate literally like 400 contracts, so that just didn't make any sense. But the complications you get if you try and buy accounts receivable is, or is it good AR? Is it all collectible? And then are you going to have a settle up period, 30 days, 60 days after the purchase of the company? So it's just a lot cleaner if the seller collects his accounts receivable.
Okay. So I don't see any additional questions at this point. So let's just simply restate again that if you are interested in buying Terry's book, go to Amazon and you can pick up a copy of the book. I also want to remind everyone, especially the business owners on the call with us, that we do offer value builder consultancy through Innovative Business Advisors. And it's a pretty easy process to start. And step one, you go to our webpage, and as you finish this particular webinar, I will send you a follow-up email that has a link directly to the questionnaire webpage. Take the Value Builder questionnaire. We'll generate your score within the system, and then we'll produce a custom report for you and go over that custom report so that you understand in an assessment value, how does your business stack up against other businesses. Now, that service is free. We've decided that it's a part of our marketing effort. So I encourage any business owner to go through that process and go ahead and get your Value Builder score. I'll move forward to the next screen. So I'm putting the web address here. It's www.innovative.com/value builder questionnaire, but you will get that link also in an email after this webinar. My cell phone number, 314-420-5095. Please call me if you have any questions, if you want to follow up. We'd be happy to talk with you. And then, of course, my email address, marquita@innovativeba.com. Now, this webinar is a part of a series of this webinar is a part of a series, and we will be doing this every month, so stay tuned. Now, I just got one more question, and I'm going to go ahead and give Terry an opportunity to answer this. So the question says you lose the step in basis in stock sale, and in stock sale you buy all the assets and all the liabilities, whether originally stated or not. So I think that's more of a statement than it is a question. Terry, would you agree?
Yeah, I agree, and you do. But what's important if you're going to do a stock sale is having your attorney involved in the process, because in the stock sales agreement, you're going to want to put certain representations and warranties in there that kind of cover your basis. Because you're right, in a stock sale, you are potentially inheriting all the liabilities, from that company. So you want to have reasonable things in there that the seller could be responsible for something that came up, in a recent stock sale that we did. It was a 1.5 years. So if anything came up, any unexpected liability from when the seller was running the company came up after we bought the company for, a 1.5 years, and it was above, I forget the exact number, but say it was above $10,000, they was responsible for it. And those are tough negotiating things. There's also, in the stock purchase, you can step up the basis. I forget, there's an IRS code for that treats it a little bit more like a asset purchase, and then you can depreciate that off over time. So that's a real advantage if you have to go through a stock purchase side. So, I agree there's advantages and disadvantages to doing an asset purchase versus a stock purchase, but you have to weigh those out, and that's why it's really important to talk with somebody, whether it's somebody like Marquita or I that's, helping people with mergers and acquisitions, or, really importantly, have an attorney that's experienced in mergers and acquisitions. I've been through 2 cases now where the seller went to their estate planning attorney to help them through, selling their company, and that's a bad idea. If that attorney doesn't have experience in mergers and acquisitions, they're not going to be helpful to you.
And Terry, I think, and again, the questions are for you, but just a comment, as we're sitting here now talking about asset sales versus stock sales, a caveat on that particular conversation is, even with M&A professionals, we are limited, or I would say walking a thin line as we move from asset sales to stock sales. Most business brokers can act as intermediary in an assets sale, but depending on the stock sale and the complexity of the stock sale, if we move into that arena, we do need to bring in specialists who have specific licenses to handle those, and those licenses exist in M&A investment firms, typically referred to as investment bankers, and certain law firms that carry those licenses to be able to handle those kinds of transactions. So that's something to know, and a question you want to ask if in fact your intermediary begins to talk about doing a stock sale. You want to make sure that you've got someone who is qualified and licensed to handle that kind of a deal. Terry, go ahead.
It's all about bringing in the right people to having the right people on your team. One thing just quickly, that we didn't talk about is owner financing. If you're confident that you have a strong company buying your company, there's different things that you can do as far as deferred compensation plans, and stuff like that can really help your tax consequence also. So there's a lot of different ways to go about it, and it just helps to have somebody that can look at it from all angles, because you don't know what you don't know, right?
That's right. You don't know what you don't know. And again, encourage everyone to hop on over to Amazon and purchase a copy of Terry's book. Keep an eye out for the emails. Go on over to Innovative and take the Value Builder questionnaire. And look for an email in about 3 weeks from me, inviting you to the next in our monthly series on building value in your company. Thanks, everyone, for participating.
Have a great day.